Hey everyone, welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're talking about something that hits Wall Street like clockwork 4 times a year. Triple Witching Friday. No, it's not some market horror story, but if you're trading around it without knowing what's happening, it can feel like one. For seasoned traders, triple witching is a high alert event. For others, it might just sound like another financial buzzword. But whether you're managing long term investments or placing precision trades with digital options, understanding what happens during triple witching and how this quarter might be different can give you a serious edge. So let's break it down. What is triple witching, really? Every quarter, on the third Friday of March, June, September, and December, something big happens under the surface of the market. Three major types of derivatives expire at once: stock index futures, stock index options, individual stock options, and when all of them expire on the same day. That's what we call triple witching. Picture it like three busy intersections in a city all losing their traffic lights at once. Suddenly, traders, institutions, and algorithms are all trying to settle, roll over, or close out positions fast. It doesn't always cause chaos, but the potential for volume spikes, short-term volatility, and odd price action is very real. The term triple witching was coined in the 1980s, and while it sounds ominous, it's really about market convergence, a quarterly reset where liquidity surges and institutions reposition. Why triple witching usually means more volatility? Let's be clear. This isn't just about contracts expiring. It's about how traders respond to those expirations. Large funds and institutions need to unwind positions, hedge new ones, rebalance their books. Now layer on algorithmic trading, retail FOMO, momentum chasing, and billions in notional value expiring. And what do you get? 2x or 3x the normal volume, and potentially sharp price swings that don't always reflect fundamentals. Market makers and dealers also adjust their delta and gamma exposure, which can pin prices or, in some cases, amplify short-term moves in unexpected ways. But this time, it might be a market reset. Here's what's different about this quarter's triple witching. The Fed has kept rates steady for several meetings in a row. Inflation data is cooling. Earnings season, mostly solid. The market is adjusting to a higher for longer interest rate environment. And the VIX, the fear gauge, is relatively calm. So instead of acting as a volatility trigger, some analysts believe this quarter's expiration might be more like a cleansing moment, a reset, a chance for portfolios to realign as short-term noise gets flushed out. One senior derivative strategist put it well. This particular expiration could reduce near-term imbalances. A lot of the choppy positioning we've seen will get flushed out. So rather than setting off fireworks, this triple witching might actually stabilize the stage for Q2. Sector rebalancing and ETF adjustments. Another subtle but important aspect: sector rotation. Institutional managers use these quarterly expirations to review and adjust based on macro trends and updated economic data. That means tech stocks could see action depending on recent earnings. Energy positions might shift based on inflation and oil prices. Financials often get rebalanced alongside bond market developments. Healthcare and utilities could see flows if risk-off sentiment creeps in. And then there's the ETF rebalancing that often happens in sync. This isn't necessarily volatile, it's just movement. Movement that can clean up distorted positioning and clarify what's driving real market direction. What traders and investors should watch? If you're active around triple witching, or even just observing, it pays to keep these tips in mind. Expect higher volume, especially in the last hour, what some call the witching hour. Don't overreact to short-term price swings. They may reverse quickly. Watch open interest and max pain levels. These can give clues to where prices might gravitate. Be aware of gamma exposure. Big gamma positions can create a magnetic pull on price. Understand that the real market impact often comes in the days after expiration, not just on Friday itself. Also, be careful placing new trades during the week of expiration. Spreads can widen, execution can lag, and slippage increases when volume is chaotic. Digital options, a precise way to trade events like this. Now, if you're looking for a more controlled way to trade around events like triple witching without getting chewed up by noise, digital options offer an interesting advantage. Here's why. You get fixed payouts, defined risk and reward, simpler binary outcomes, either the price finishes above or below a target at expiration. That makes them ideal for short-term directional plays during elevated volatility where you want to bet on movement, but not get exposed to all the turbulence in between. Let's say you expect a sharp move after rebalancing but aren't sure about the path. Digital options allow you to define your outcome, take your shot, and move on. Platforms like crystalballmarkets.com make this kind of trading accessible. You can trade global assets, structure your risk, and capitalize on price clarity without overcomplicating things. Plus, digital options can complement your broader portfolio. Use them to hedge, to speculate, or to sit on the sidelines with precision when the market feels foggy. The bottom line, triple witching isn't new, but each quarter tells a different story. Historically, these days spike volatility, stir up short-term noise, and give traders headaches. But this time, there's reason to believe it could bring order, not chaos. With the Fed on pause, inflation cooling, and risk appetite cautiously returning, this triple witching might act more like a reset button than a volatility trap. Still, don't let your guard down. Watch the flows, respect the positioning, and think beyond the day itself. The post-expiration move often tells the real story. And if you're looking to trade smarter around events like this, digital options can help you do that. With defined outcomes, you stay in control, even when the rest of the market feels like a coin toss. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for joining me. If you found this episode helpful, make sure to follow, leave a review, and share it with your trading group. And as always, trade with clarity, not noise. Until next time.